My mother got a denial letter on a Thursday afternoon in March. She'd had knee surgery 8 weeks earlier. Pre-authorized. In-network surgeon. In-network hospital. She had done everything they told her to do, in exactly the order they told her to do it. The denial came anyway. 7 pages long. Single-spaced. The reason given was 4 words. Not medically necessary. She called the number on the letter. She was on hold for 40 minutes. When someone finally picked up, they told her the decision had been made by a medical reviewer. She asked for the reviewer's name and credentials. The representative said that information was not available. I have been trying to understand that phone call ever since. What I found, in federal court filings, congressional hearing transcripts, and internal insurance documents that became public through litigation, is that what happened to my mother is not an anomaly. It is a pattern. A documented, studied, profitable pattern. And the companies running it are not hiding. They are just betting you won't look. Today I'm going to show you 8 ways insurers deny legitimate claims, ranked from the ones that are embarrassing but survivable all the way to the one that has a name, a paper trail, and people who testified about it under oath. And I'm going to tell you the 3 things you can do, not eventually, tonight, that the industry's entire model depends on you never figuring out. Number 8 is probably sitting in your email inbox right now. Number 8, the wrong code shuffle. You did everything correctly. Called ahead. Confirmed the hospital was in-network. Confirmed the surgeon was in-network. Got a reference number. Wrote it down. 6 weeks after the procedure, an envelope arrives. You already know what it is before you open it, because envelopes from insurance companies never feel good. The denial reason, billing code mismatch. The hospital submitted a 99214. Your plan required a 99213 for that service category. 1 digit separating you from your money. Before you call the hospital to argue, understand what you're actually dealing with. Insurance companies employ teams of people, not doctors, not nurses, people with billing audit training, whose job is to find discrepancies between what a provider submitted and what the insurer's internal coding manual says the code should be. These manuals are proprietary. You cannot request them. Your doctor cannot request them. The hospital's billing department can try to appeal with documentation, but they're appealing to a standard they've never been allowed to read. The American Medical Association has been tracking this for years. They call it claim editing, and they've documented that different insurers apply different coding logic to the same procedures. What Cigna's system approves, Aetna's system flags. The code didn't change. The patient didn't change. The procedure didn't change. The insurer's algorithm did. I want to be fair here, because this is the one place on this list where the insurer has a partial argument. Medical billing coding genuinely is complicated. Hospitals do sometimes submit incorrect codes, sometimes because of clerical errors, sometimes because different providers in the same visit coded separately and the codes conflict. The system is a mess. But here is where the partial argument falls apart. A health affairs analysis from 2022 tracked coding denial rates by procedure cost. For office visits under $200, the coding denial rate was negligible. For surgical procedures over $20,000, it spiked to nearly 12%. That pattern doesn't reflect billing complexity. It reflects financial incentive. The codes the insurer disputes are the codes on the expensive procedures. Every single time. If a coding denial lands in your mailbox, do not call the insurer first. Call your provider's billing department and ask them to initiate a peer-to-peer review. That's a direct conversation between your doctor and the insurer's clinical staff. That conversation has a dramatically higher overturn rate than a standard written appeal because it's harder to hide behind a coding manual when a physician is on the other end of the line. Number 7, the 1.2-second doctor. I want you to picture something specific. A physician, your physician, spent 40 minutes with you at your last appointment. She reviewed your imaging, your blood work, your history. She consulted with a colleague. She wrote you a referral for an MRI, explaining in clinical detail why she believed it was necessary. That referral goes to your insurer for prior authorization. On the other end of that request is an AI system called NH-Predict. A Senate Finance Committee investigation in 2023 found that this system, developed by and deployed by United Healthcare, was making prior authorization decisions at a rate that worked out to an average of 1.2 seconds per case. That's not a typo. 1.2 seconds. Your doctor spent 40 minutes. The AI spent 1.2 seconds. And if the AI said no, you didn't get the MRI. United Healthcare has disputed the framing of that finding, arguing that the algorithm was a screening tool and that humans reviewed flagged cases. That's their position, and I'll put their full statement in the description so you can read it yourself. But the class action lawsuit filed against them in 2023 by patients who alleged they were denied necessary care through this system included testimony from former employees who said the denial targets were set at the company level and that approval rates that ran too high triggered internal review of the approving team. I'm not going to tell you what to conclude from that. I'll just tell you what it means in plain language. If the people saying yes get reviewed and the people saying no don't, the incentive structure points in one direction. The AMA's 2022 survey found that 33% of physicians, 1 in 3, said prior authorization had directly led to a serious adverse event for a patient in their care. Hospitalizations, permanent damage, in some cases, death. That number was not from a plaintiff's attorney. It was from the physicians themselves, surveyed anonymously. Here's where I think reasonable people can disagree. Prior authorization was not invented as a denial machine. It was invented to stop genuinely unnecessary procedures, to push back on overtreatment, which is real and which costs patients money too. In theory, a well-run prior auth system saves you from having surgery you didn't need. The problem is not the concept. The problem is what happens when the denial rate is a revenue target rather than a clinical outcome. When the answer is no and nobody checks, and when the answer is yes and somebody does, that's not a medical system. That's a financial system wearing a medical system's clothes. Number 6, the policy they approved and then took back. This one requires you to go back in time slightly. You applied for health insurance. You filled out the application honestly. You listed your medical history to the best of your ability, which, if you are a normal person and not a physician with a photographic memory, means you listed what you remembered in the categories the form gave you, in the time you had before the enrollment deadline. The insurer reviewed your application. They approved it. They accepted your first premium payment, and then your second, and then your third. Some of them accepted payments for 2 or 3 years. Then you filed a big claim. The insurer went back to your original application. They found a discrepancy. Not fraud. Not a lie. A discrepancy. Maybe you didn't mention a prescription you took briefly in 2009 for anxiety because you didn't consider it a significant medical history item. Maybe you answered no to a question about cardiovascular conditions because you didn't know your doctor had noted borderline hypertension in a chart 3 years earlier that you never saw. They classified it as material misrepresentation. They rescinded your policy. Not going forward. Retroactively. Back to the date of issue. Every claim they ever paid under that policy got reversed. You now owe the hospital, the lab, the specialist, the anesthesiologist, everything that was covered, retroactively uncovered. The HHS Office of Inspector General investigated this practice in 2010 after a series of congressional hearings made it politically impossible to ignore. They looked specifically at WellPoint, United Health, and Assurant. Between 2003 and 2007, those 3 companies rescinded just over 19,776 policies. The investigation found the rescissions clustered statistically around the filing of expensive claims. During those same years, one company gave bonuses to the employees who handled rescissions, paid by the number of successful rescissions they completed. One employee's annual total was 1,600 policies. Her bonus check, $20,000. The Affordable Care Act restricted rescission in 2010. You can no longer be retroactively rescinded for innocent mistakes on your application. The law uses the word innocent, and that word is doing a lot of work, because the entity that decides whether your mistake was innocent or intentional is the same entity that benefits financially from deciding it was intentional. They draw the line. They draw it where it's profitable. The rescission play requires them to dig through your past to find something to use against you. That takes work. What number 5 requires is simpler. It requires nothing but patience and a calendar. Number 5, pending. Pending. Still pending. The most profitable word in insurance is not denied. Think about what denied triggers. It triggers your right to appeal. It starts a clock. Regulators require insurers to respond to appeals within specific windows. It creates a documented dispute with a paper trail. The word pending triggers none of that. Pending is not a decision. Pending is the suspension of a decision. And a suspended decision has no appeal clock, no required response window, and no regulatory tripwire. While your claim sits in pending status, the insurer is holding the float, the investment income from your premium dollars that they keep until claims are paid. Warren Buffett has described the insurance float as the primary engine of Berkshire Hathaway's investment portfolio. He built one of the largest fortunes in American history on the gap between when insurance companies collect premiums and when they pay claims. The longer that gap, the larger the float. Every day your claim is pending is a day the float earns. The California Department of Managed Healthcare released a report in 2022 documenting claims that had been sitting in pending status for 120 days, for 180 days, in some cases, 240 days, 8 months. Patients who had already paid providers out of pocket to avoid collections were still waiting for reimbursement 8 months later. The internal term for this, which appeared in claims training materials obtained through litigation in Texas, is aging the claim. The documentation framed it as a resource management strategy. A law professor who testified before the Texas House Insurance Committee put it more precisely. She said the delay creates what actuaries call a lapse and abandon rate, the percentage of policyholders who stop pursuing a claim before it's resolved. Based on the internal data she had reviewed, that rate ran between 30 and 40% for claims that were delayed past 90 days. Between 30 and 40% of people simply stopped. They got tired. They got confused. They got busy. They got sick. They died. And the insurer kept the money. I'll give them this much. Some claims do require extended review. Disputed liability claims, multi-provider billing questions, coordination between two insurance plans. Real complexity exists in the system. Not every delay is a delay strategy. But when you map the aging rate against claim size, the same pattern appears that we saw with coding denials. Small claims get resolved. Large claims age. The correlation is not subtle. It shows up in state regulatory data across multiple years and multiple insurers, and the regulators who have looked at it have described it as structural, not accidental. Number 4. The doctor who doesn't answer. Let me tell you about a specific phone call. In 2023, investigators for the New York State government were looking into United Healthcare's provider directory for one of its Medicaid managed care plans. They decided to do something simple. They took a list of 371 providers listed in the directory as in-network, and they called them. Not 371 different checks. 371 phone calls. Of those 371 listed in-network providers, 28% were reachable, took the insurance, and had appointments available. The other 72% were either unreachable, disconnected numbers, no answer, no callback, or did not take the plan, or had no record of being affiliated with it, or had closed their practice. The directory said they were there. Most of them weren't. The industry has a name for this. Ghost networks. Provider directories populated with physicians who have left the plan, retired, moved, changed affiliations, or in some documented cases, died. The names are still there. The phone numbers are still listed. The accepting new patients checkbox is still checked. Here is why that's not just an administrative inconvenience. When you use an out-of-network provider, your insurer can pay a fraction of the bill or nothing at all and charge you the difference. That's the penalty for going out of network. But if you went out of network because the in-network provider the directory listed doesn't exist, if you called 7 numbers and 3 were disconnected, and 2 said they don't take your insurance, and 1 had a 4-month wait, your insurer can still apply that penalty. They created the gap. You fell into the gap. They charged you for falling. A patient advocate in California described a client who had a psychiatric crisis on a Saturday night. She called every mental health provider listed in her plan's directory for that county. She reached no one who could see her. She ended up at an out-of-network crisis facility because it was the only facility available. Her insurer paid 20% of the bill. The remainder, $34,000. The Government Accountability Office looked at this across Medicare Advantage plans in 2017 and found errors in more than half of provider directory locations. Wrong addresses, wrong phone numbers, wrong specialties. Providers who had never participated in the plan and had no idea why they were listed. Half. An insurer that sells you a network is selling you access to care. A directory that doesn't reflect real access is selling you a document. The document costs the same. The care may not exist. Number 3. The bill that arrived after the anesthesia. Here is a sequence of events that happens to Americans every day. You need surgery. You do your homework. You call your insurer and confirm your surgeon is in-network. You call the hospital and confirm it's in-network. You ask specifically if there will be additional providers involved and whether they'll be in-network. You write down the names of the people you spoke with. You do everything right. You go under anesthesia. While you are unconscious, a physician you have never met, from a group practice you have never heard of, walks into your operating room and performs anesthesia services. That physician is not employed by the hospital. Her group practice has no contract with your insurer. She is out of network. Her bill arrives 6 weeks after your discharge. $18,000. Your plan covers out-of-network emergency services at a reduced rate. Elective surgery isn't classified as emergency. Her payment from your insurer, $3,600. The balance bill to you, $14,400. The No Surprises Act, which went into effect in January 2022, was supposed to end this. And for the specific scenario I just described, a scheduled procedure at an in-network facility, it mostly has. Insurers are now required to cover out-of-network providers at facilities where you had no reasonable choice, and balance billing in those cases is restricted. But the ambulance is a different story. If you have a medical emergency and an ambulance picks you up, that ambulance service is very likely not in your network. It couldn't be. You didn't choose it. Ground ambulance transport is explicitly excluded from the No Surprises Act's protections. A KFF analysis from 2023 found that 72% of ground ambulance transports involve out-of-network providers. The average balance bill, $897. For critical care transport, over $3,000. You had a heart attack. You did not call around for in-network ambulance options. You got in the ambulance that came. $3,000 later, you were learning about network contracts. The Consumer Financial Protection Bureau released findings in 2024 showing that enforcement of the No Surprises Act's good faith estimate requirements, the part that requires providers to tell you costs in advance, was inconsistent, that some providers were still issuing surprise bills for protected procedures, and that in some cases patients were being sent to collections for bills the law said they shouldn't know. The law is real. The gap is also real. And if you are transported by ambulance in the next 12 months, the gap may find you before the law does. Number 2, the exclusion they tested before you read it. Your insurance policy has a section called Exclusions and Limitations. It averages 47 pages. A 2019 study published in the Journal of Health Economics found that comprehending it at a functional level requires the equivalent of a graduate school education. The average American reads at a 10th grade level. Your insurer is legally required to give you this document. They are not required to confirm you read it. They are not required to walk you through it. They are required to make it available, typically during a 10-day enrollment window during which you are also confirming your network, submitting payroll paperwork, and continuing to do your actual job. Inside those 47 pages is the clause they'll use when your claim is expensive enough to matter. 3 examples, because this is not theoretical. The experimental treatment exclusion lets your insurer deny coverage for any treatment they classify as experimental or investigational. The key word is they, not your doctor, not the FDA, not the peer-reviewed medical literature. Your insurer makes the determination using internal clinical criteria that are proprietary, meaning they cannot be independently reviewed, challenged, or compared to any external standard. A 2020 study in the Journal of Clinical Oncology examined this across cancer treatment cases. They found that experimental treatment exclusions were applied to deny coverage for standard of care treatments, treatments used routinely by oncologists across the country, in 18% of cases. That's not fringe medicine. That's 1 in 5 cancer patients being told their established treatment is experimental by an insurance company, using a definition of experimental that no one outside the company can audit. The coordination of benefits clause applies when you have 2 insurance plans, through your employer and your spouse's, for example. The clause governs which insurer pays first. The rules are complex enough that a non-trivial percentage of claims fall into coordination gaps, situations where each insurer argues the other is primary and neither pays. The patient, who has been paying 2 premiums, gets 0 coverage. The subrogation clause is the one that genuinely shocked me when I first found it. If you're in a car accident and your health insurer pays your medical bills, and you later receive a personal injury settlement from the at-fault driver's insurance, Your health insurer can claim a lien against that settlement, not just recouping what they paid. In states with super lien subrogation statutes, the lien can exceed what they paid. A nurse in Georgia was hit by another driver. She received a $30,000 personal injury settlement. Her health insurer's subrogation lien was $41,000, more than her settlement. She had been injured by someone else's negligence. Her settlement paid her insurer's attorneys, paid down the lien, and left her $11,000 in debt. She was the victim. She ended the process owing money to her insurance company. I don't know what to call that other than a structural obscenity. And it's legal, it's in your policy, and it was designed by attorneys who were paid to test how much denial coverage the language would generate per dollar of legal exposure. The clause didn't end up in your policy because someone thought it was fair. It ended up there because someone ran the numbers. Number 1. Deny, delay, defend. The strategy with a name. In 2008, a congressional subcommittee issued a report on the claims practices of 3 of the largest health insurers in the United States: WellPoint, which later became Anthem, Humana, and United Health Group. They were not investigating a data breach or a compliance failure. They were investigating whether these companies had adopted explicit corporate strategies for systematically denying, delaying, and underpaying legitimate health insurance claims. The phrase that emerged from the internal documents, the phrase the subcommittee used in its final report, was deny, delay, defend. It was not invented by investigators. It was found in the company's own internal training materials. Let me go through what each word actually meant in practice. Deny. The internal documents showed that for certain claim categories, denial was the default first response, not an outcome of review, but the starting position of review. Reviewers were tasked with finding a reason to deny, not with evaluating whether the claim was valid. If no viable reason surfaced after a second pass, the claim was approved. The logic was inverted. A former claims manager at a southeastern insurer testified before the subcommittee that her team was instructed to issue a denial and request additional documentation on any claim over $10,000 as a first response, regardless of whether the documentation they had was sufficient to approve it. She said the word she heard most often was friction. The goal was to create friction, and friction worked. The abandonment rate, the percentage of policyholders who received a denial and never filed an appeal, ran at approximately 38% for high-value claims. Not people who appealed and lost. People who received a letter, put it down, and never picked it back up. 38%. That number isn't a side effect of a flawed system. It's the return on investment for the friction strategy. Delay. The investigation found documented evidence that some insurers had structured their appeals process to maximize complexity without technically violating response time regulations. Documentation requirements were added specifically to pending appeals. Response windows for claimants were shortened while the insurer's own review period was extended. Appeals were routed to departments with higher workloads during peak claim seasons. One internal training document introduced into evidence contained this line: every additional step in the appeals process increases the probability of claim abandonment. They called claim abandonment a probability to be increased. A separate piece of evidence that came out through litigation, not from the congressional hearing, but from a California state court case a few years later, showed internal communications in which a claims operations director referred to the appeals backlog as a self-resolving pipeline. Self-resolving because people give up. The pipeline resolves itself. Defend. This is the piece that makes the first 2 sustainable indefinitely. Insurance regulation in the United States is state by state. There is no federal agency with comprehensive enforcement authority over private health insurers the way the SEC has authority over securities markets or the FDA has authority over drugs. A company operating across 50 states faces 50 different regulatory bodies with 50 different funding levels, 50 different levels of political independence, and 50 different histories of industry influence. The insurance industry spent $188 million on lobbying in 2023 alone. Across a decade, that's a lobbying investment in the range of $1.50 to $2 billion, most of it directed at state legislatures and state insurance commissioner offices. Some of those commissioners are former insurance industry executives. Some of the staff attorneys in those offices came from the companies they now nominally regulate. I am not calling this a conspiracy. I am calling it a structural reality that the industry has spent enormous resources to create and maintain. The system that is supposed to protect you from deny, delay, defend is staffed, in many states, by people who came from the companies running deny, delay, defend. Now the number. California's Department of Managed Healthcare audited prior authorization decisions by the state's largest health insurers in 2021. They used an independent clinical panel to review a sample of denied prior authorization requests. Their finding, 25% of the denied requests were incorrectly denied. 1 in 4. If that error rate held nationally, and California's insurers are not uniquely bad. If anything, California has more aggressive state oversight than most, applied to the roughly 35 million prior authorization decisions made each year. That is 8.75 million incorrect denials annually. Not 8.75 million errors in a system that sometimes makes mistakes. 8.75 million times a real person, someone managing a disease, recovering from an accident, navigating a diagnosis, was told no when the clinically correct answer, assessed by an independent physician panel, was yes. And based on the abandonment rates documented above, somewhere between 30 and 38% of them stopped there. I keep returning to my mother's phone call. The whole time. The reviewer whose name couldn't be shared. The 40 minutes she spent and the 4 words she received. Not medically necessary. I've since looked up the appeal overturn rate for that denial category in her state. It runs at about 43% in the first round, which means that if she had filed the appeal, if she had known she could, if she hadn't been exhausted from a surgery and frightened by a 7-page letter, there was nearly a 1 in 2 chance the denial would have been reversed. She didn't know that. The industry counted on it. 3 things to do before your next claim. If you take nothing else from this video, take these 3. First, get the denial in writing before you do anything else. A verbal denial, from a phone representative, from an automated system, from anyone who is not sending you a letter, is not a legal denial. It is a phone call. Hang up. Call back. Tell them you need the denial in writing with the specific policy clause cited and the name and credentials of the reviewing clinician. If they refuse to provide it, document the refusal, including the date, the time, and the name of the representative. That documentation is the foundation of what comes next. Second, request the clinical review criteria before your next procedure, any procedure that might need prior authorization. Under the ACA, you have the legal right to the clinical criteria your insurer uses to evaluate medical necessity. Call member services and ask for the coverage determination guidelines for the procedure code your doctor submitted. They may resist. They may transfer you. Stay on the line. Get it in writing. If the criteria they're using to deny your claim are proprietary and unavailable, say that explicitly in your appeal letter. It matters. Third, file the appeal. File it even when you're tired. File it especially when you're tired. The 38% abandonment rate is the business model. Your insurer isn't hoping you'll appeal. They are structurally counting on enough people not to. The first internal appeal overturn rate for employer-sponsored plans runs around 40 to 50%, depending on the state and the claim category. The external review overturn rate, where an independent physician who has no relationship with your insurer evaluates the denial, runs higher. The appeals process exists. Most people don't use it. The people who do win roughly half the time. Don't be the 38%. If you have a family member fighting a denial right now, send them this video. Not because a YouTube video fixes anything. Because they need to know this has a name, deny, delay, defend, and a paper trail, and a congressional hearing, and a California audit, and 8.75 million incorrect denials per year. They need to know they are not confused, and they are not alone, and they are not wrong. Drop your denial story in the comments. I read every one. Because what I'm building next takes your stories and puts them next to the earnings reports. And when those 2 things sit in the same frame, what the numbers reveal about where your premiums actually go is going to make everything in this video feel like the introduction. Subscribe. Because we are not close to done. In insurance, the clause that costs you most is the one they wrote quietly, at 2 in the afternoon, in a conference room you will never enter, during a meeting you will never know happened. You know the clause exists now. Start reading.